In early February 2016, Bangladesh Bank, the central bank of Bangladesh, held foreign reserves in an account at the Federal Reserve Bank of New York. Like many central banks, it used the SWIFT messaging network to send payment instructions to other financial institutions. A key detail, often misunderstood, is that SWIFT is primarily a secure messaging system used to exchange payment orders. The actual movement of funds depends on the banks that receive and act on those messages. On the night of February 4th, 2016, and into the early hours of February 5th, a series of fraudulent payment instructions were sent from Bangladesh Bank's SWIFT environment to the New York Fed, requesting large transfers to accounts overseas. Reports and later legal filings describe an attempted theft approaching $1 billion, with $81 million successfully routed to accounts in the Philippines and another $20 million directed to Sri Lanka, later recovered. The New York Fed later stated that the payment instructions were fully authenticated through standard SWIFT protocols and that there was no evidence its own systems were compromised, an early public indicator that the attackers were using valid-looking credentials from the sending side. That single point is the heart of why this case became globally instructive. The messages looked legitimate at the technical authentication layer, even though the intent behind them was not. The story might have ended with far greater losses if not for interruptions that were small on paper but meaningful in practice. Reporting describes how several of the transfer requests were flagged for review, including because a recipient detail contained a spelling error that drew attention at a critical moment. At the same time, Bangladesh Bank's own ability to see what was happening was affected. Investigations and industry write-ups describe malware that interfered with normal transaction monitoring. One widely repeated detail is a printer disruption that prevented routine hard copy logs from printing when staff needed them most. From an educational viewpoint, Part 1 is about a modern paradox. A bank can do the right thing mechanically, sending authenticated SWIFT messages, yet still be exposed if the local environment that creates those messages is compromised. Authentication is necessary, but not sufficient, when attackers learn to operate inside the same tools and workflows that legitimate staff use. And that is how the Bangladesh Bank heist begins, not with a dramatic physical scene, but with trusted systems behaving normally, while the intent behind the activity is quietly abnormal. To understand why the Bangladesh Bank incident mattered beyond one institution, it helps to separate two layers: the SWIFT network's security and the security of each member's local SWIFT interface and surrounding environment. The heist did not require breaking the concept of SWIFT as a global messaging standard. Instead, evidence described in legal filings and industry reporting points to a compromise inside Bangladesh Bank's own systems that generated messages using the bank's legitimate identity. This distinction is essential for a calm educational narrative. Large financial systems are federated by design. SWIFT can require strong messaging standards, but each participating organization must secure its endpoints, operator workstations, credentials, and supporting servers. If one member's local environment is weaker, the attacker's path of least resistance is to enter there and then send messages outward that look valid. Industry reporting and later analysis discussed malware tailored to the Swift software environment, including techniques intended to alter records or hide evidence of fraudulent activity. The goal, described at a high level, was not simply to send messages, but also to avoid rapid detection by interfering with logs, reports, or operator visibility. Educationally, this becomes a case study in security boundaries. Organizations often treat a specialized system as secure because it is specialized, but specialized systems still depend on everyday components, operating systems, admin accounts, patching routines, network segmentation, and monitoring. If an attacker compromises admin privileges around the Swift environment, the attacker may be able to behave like an authorized operator, and the rest of the world will initially see only authenticated instructions. The New York Fed's public statement emphasizing swift authentication and no sign of compromise on the Fed side reinforced this boundary lesson. It suggested the attack was primarily about who controlled the sending environment, not about defeating the receiving bank's core infrastructure. Part 2 also highlights why detection is not a single alarm. Banks rely on layered reasonableness checks, unusual destinations, odd formatting, atypical beneficiary profiles, timing during holidays, or patterns inconsistent with the customer's normal behavior. Reuters reporting described how unusual characteristics of the payment orders drew attention, including a detail that raised alarm bells and contributed to review. So, the documentary lesson here is gentle but firm. The security of international payment messaging is only as strong as the local operational security of each participant. When one participant's local environment is compromised, the global system can still be used correctly in form and dangerously in effect. One of the most compelling parts of this real case is that the attempted loss was far larger than the final confirmed loss. In multiple accounts, attackers attempted to move close to $1 billion, but most transactions were stopped before settlement, leaving the well-known figure of $81 million successfully transferred to the Philippines. This is not a story of luck alone. It is a story of friction, small layers of scrutiny and timing that slowed things down enough for humans to intervene. The flagged transactions at the New York Fed demonstrate why secondary review steps exist. Even when messages are authenticated, unusual transfer patterns can trigger caution. And the reporting about a spelling error affecting one of the requests illustrates how anomalies can become a practical stop signal in a high-stakes workflow. At Bangladesh Bank, The detection and response were complicated by visibility problems. Industry summaries describe the way malware interfered with normal reporting, including the widely cited disruption involving the printer that normally produced transaction confirmations. Whether or not one single device caused the delay, the deeper lesson is consistent. Attackers try to reduce an organization's ability to notice what is happening in real time. When a bank's monitoring is slowed, the response window shrinks. The institution must not only identify suspicious activity, it must also send cancellation messages, contact counterparties, and coordinate across time zones and holidays. Accounts describe how timing, weekends, and regional holidays added complexity to fast coordination. In global finance, hours matter and calendars matter. Part 3 also introduces the second stage challenge. Once funds arrive in another jurisdiction, recovery becomes a race involving banks, regulators, and legal processes. Reports describe the funds moving through accounts at a commercial bank in the Philippines and later being withdrawn and dispersed. This is where the incident becomes not only a cybersecurity case, but also a cross-border coordination case. Technical containment is only the first step, and legal cooperation becomes the next. The educational message of Part 3 is practical and non-dramatic. Layered controls, behavioral monitoring, formatting checks, manual review thresholds, and fast communication paths can reduce loss even when an attacker manages to send authenticated messages. The Bangladesh bank heist is remembered partly because it shows both sides at once, how much damage a compromised endpoint can enable, and how much damage a few well-placed friction points can prevent. Once the $81 million reached the Philippines, the incident entered a complicated phase where cybersecurity met the realities of financial processing, local compliance rules, and institutional accountability. Reuters reporting described how the attackers routed funds into accounts at a Philippine bank, and that much of the money was later moved through channels that made tracing and recovery difficult. This part of the story matters because it shows a recurring truth about cyber-enabled financial crime. The transfer is only the midpoint. Afterward comes the challenge of slowing down withdrawals, freezing accounts, gathering records, and coordinating between institutions that do not share the same regulators, holidays, or legal timelines. Public coverage at the time also pointed to Philippine Senate scrutiny and broader questions about how the funds were handled after arrival. Separately, later reporting described Bangladesh considering or pursuing legal actions connected to recovery efforts, illustrating how long these disputes can remain active. In documentary language, Part 4 is about the handoff problem. A bank can detect fraud and send urgent messages, but if the receiving institutions cannot react quickly due to timing, verification steps, or compliance gaps, the opportunity to freeze funds can narrow rapidly. This is why incident response plans in banking increasingly treat cross-border contact lists and predefined escalation procedures as core operational security, not optional paperwork. This phase also demonstrates why cyber defense cannot be only technical. Yes, the breach involved malware and credentials, but containment and recovery required governance. Who had the authority to freeze accounts? Who could confirm legitimacy? And how quickly institutions could trust the warning? The New York Fed's statement that the instructions were authenticated via SWIFT protocols underscores the tension. Authentication proved the messages came from the bank's identity, but that did not prove they represented the bank's true intent. So, Part 4 leaves the audience with a broader lesson. The global banking system moves on trust plus procedure. When criminals operate inside trusted procedures, the defense must include rapid human coordination across borders, especially once funds land in another jurisdiction. The Bangladesh bank heist became a catalyst for industry-wide reform, especially around how SWIFT customers secure their local environments. In May 2016, SWIFT announced the Customer Security Program, CSP, to reinforce security across the community, emphasizing information sharing, forensic support, and a common security direction. Over time, that effort matured into the Customer Security Controls Framework, a set of mandatory and advisory controls for SWIFT users that evolves to address emerging threats. The key idea is straightforward. If attackers exploit the weakest participant's local environment, the community needs a baseline that reduces how weak can be. Professional summaries describe how CSP pushes institutions toward annual assessment and attestation, turning security expectations into reoccurring governance tasks rather than one-time projects. The objective is not perfection, it is consistency, making sure essential controls are present everywhere, not only at the biggest banks with the largest budgets. In educational terms, this part of the story highlights a healthy shift in mindset. Before incidents like Bangladesh Bank, some organizations treated SWIFT connectivity as a specialized IT function. Afterward, it became clearer that SWIFT connectivity is a high-value operational pathway that requires executive-level oversight, access controls, monitoring, segmentation, and incident readiness. Industry analysis also emphasizes a subtle but important point. SWIFT itself does not send money, yet the ability to send messages that instruct money movements makes SWIFT-connected environments exceptionally sensitive. Protecting the messaging layer therefore protects the real-world outcomes. Part 5 also reminds viewers that reforms often arrive after harm, not before. The heist created urgency, and urgency created coordination. Banks, regulators, and SWIFT aligning on shared controls and shared language for security maturity. Whether an institution is large or small, the baseline concept helps ensure that local compromise is harder to turn into global consequence. The lesson is calm and practical. Major incidents are painful, but they can also become turning points. Moments when an industry decides to standardize protections, measure compliance, and treats cybersecurity as a shared responsibility. Years after the 2016 incident, The Bangladesh bank heist remained active in courts, investigations, and recovery efforts because cyber enabled financial theft has a long tail. The initial event may take days, but disputes about responsibility, process, and restitution can last for years. Reuters reporting and other public sources describe Bangladesh's continued efforts connected to recovery and legal accountability. On the investigative side, U.S. legal filings linked the Bangladesh bank cyber heist to broader cyber operations described in a criminal complaint, noting the approximate loss amounts and the attempted theft approaching $1 billion. This is not the center of the educational takeaway, but it matters as context. Sophisticated actors can reuse tools in tradecraft across multiple operations, which is why industry defenses must assume capable adversaries rather than only opportunistic ones. What endures most from this case are the lessons that do not depend on any single attribution. First, authentication is not the same as authorization. The New York Fed emphasized the messages were authenticated via SWIFT protocols. The tragedy was that the local environment generating those messages did not reflect the bank's true intent. Second, resilience requires visibility. If monitoring tools, logs, or reporting workflows are disrupted, even in small ways, response slows down. Accounts describing interference with reporting mechanisms highlight how attackers try to buy time. Third, cross-border readiness is part of cybersecurity. Contact trees, escalation procedures, and rapid freeze coordination matter just as much as endpoint defenses when money can move internationally within hours. Fourth, shared baselines raise collective safety. SWIFT's CSP and CSCF represent an industry decision to make essential controls universal rather than optional. In a final documentary frame, the Bangladesh bank heist is a story about modern trust systems. A single compromised local environment used a trusted global channel to attempt extraordinary transfers. The event did not break global finance, but it reveals that global finance depends on the daily cybersecurity discipline of every connected institution. That is why this real case remains one of the most educational examples of cyber risk in international payments. It teaches, quietly and clearly, that the strongest networks still need strong endpoints, strong processes, and fast human coordination to stay safe.